This is ACC Amit Kumar and we'll discuss with you the June 2019 question on consolidation based on income statement. Let's read it together. So whenever you see a question, don't read it from the beginning, read it from the requirement first. And what is the requirement? The requirement is explain how Alpha should classify its investment in Gamma, that is note 7 in its consolidated financial statements for the year ended 31st March 2007. So first things first, always when you begin a question, you should always write the group structure first. So working note number 1 is the group structure, who all exist. Alpha is the parent. They have an investment in Gamma. Compute the carrying amount of Alpha's investment in Gamma in its consolidated statement of financial position as at 31st March. Ignore deferred tax. This is a thank you line. Prepare consolidated statement of P&L for Alpha unless specifically referred to in the notes. When we look at the question, we get to know that there is Alpha as well as Beta. Alpha has one subsidiary, Beta. So there is a subsidiary known as Beta. Subsidiary means we have control over it and will be forming part of our consolidated income statement. We need to prepare financial statements for the year ended 31st March 2007. So date of balance sheet is 31st March 2007. When is Gamma acquired? Alpha's investment in Gamma. On 1st October 2006, Alpha purchased 18% stake. The stake is 18%. Date of acquisition is 1st October 2006. The subsidiary, when it is acquired, on 1st April 2005, Alpha acquired Beta. So date of acquisition for Beta is 1st April 2005. That is beginning of 2 years before when we are presenting financial statements. And how much is the stake? Alpha acquired 90 million shares out of 120. 90 million shares out of 120. That means what is the percentage? $90 by 120. 75% stake in Beta. How much is NCI? 25%. This is the group structure. When it says that first requirement is about carrying amount of Alpha's investment in Gamma, let's sort out first note number 7. On 1st October, Alpha purchased 18% of the equity shares of Gamma at a cost of 102 million. No other single shareholders own more than 5% of Gamma's equity shares, and there are no agreements in place for any of the other equity shareholders to collaborate to influence Gamma's operating or financial policies. Alpha has the right to appoint 4 of the 10 directors. So they're not having control. They cannot appoint majority of the directors, but they can influence at least 4. So in spite of having 18% stake, what will you consider Gamma? Gamma is an investment in associate or it's simple investment. As I discussed in IFRS, we do not have any defined percentages. It is substance over form. So substance here is that Gamma is an associate of Alpha. In spite of having 18% stake, they are able to influence the financial and operating policy decisions. So Gamma is an associate. So in first part, you need to explain why it is an associate. Because we are able to influence financial and operating policy decisions according to investments in associates IAS 28. This is an associate. The second part says that we need to compute the carrying amount of Alpha's investment in Gamma. So this will normally be note number 6. Investment in Gamma. So what is the cost of investment in Gamma? Cost of investment in Gamma. It is given to us as 102,000. So I'm taking it rounding of 1,000, 102 million. Investment in Gamma is 102,000. How much is the post-acquisition profits? Gamma prepares financial statements to 31st March 2007 and its profit before tax for the year ended 31st March 2007 was 78 million. Its income tax expense for that year was 6 million. Gamma's profit accrue evenly. So how much is the profit for the year? If 78,000 is the profit before tax, after tax amount is 72 million. Out of this 72 million, how much belongs to Alpha? They acquired it in the middle of the year, that is on 1st October 2006. So total profit for accrue evenly means profit for the year for this period ended was 78 million, out of which 6 million is tax. 72 million is the profit for the year, out of which how much belongs to Gamma? Sorry, Alpha. Share of profit of Alpha. It is 78,000 minus 6,000, which turns out to be 72,000. We have a right only over 18% of it, and that too for a period of 6 months. $6,480 is the profit, share of profit for Alpha. Gamma paid dividend of 25 million on 1st March 2007. So how much is the dividend received from investment in Gamma? %, of dividend received. $4,500. So minus 4,500 is the dividend received. 18% of 25,000. To make our life easier, if we look at the Alpha's investment income, in the investment income we have dividend received from investment in Gamma, note 7, 4,500 is given to us. Even if it was not given to us, we could have calculated it by applying the percentage on this 25 million. So the carrying amount of investment in Gamma to be presented in balance sheet equals to 102,000 plus profit for the period minus dividend received. This is the amount we'll be presenting in the balance sheet. So we have covered part A and part B. Now we need to do part 3, that is prepare the consolidated statement of P&L of Alpha for the year ended 31st March 2007. Unless specifically referred to in the notes, ignore deferred taxes. So wherever the term deferred taxes is mentioned, the rate is mentioned, we'll apply deferred taxes, otherwise we'll ignore this deferred tax. And we'll be showing the workings to the nearest 1,000. This is also important. The note is also important, and we'll be showing the workings to the nearest 1,000. Let's begin reading it. Alpha's investment in Beta. On 1st April 2005, Alpha acquired 90 million shares of Beta. We have used this information in working note number 1 for a cash payment of 327. Where we'll use this information? Which note? This will be used in working note number 3 for calculating goodwill. On 1st April 2005, the directors of Alpha measured the NCI in Beta using Alpha's proportionate share of net assets. That means The goodwill is belonging to parent only, and if we are going to test for impairment, we need to gross up the goodwill for the purpose of impairment testing. And when we calculate NCI on proportional share of net assets, the goodwill belongs to parent only. There is no goodwill assigned to NCI. Where we'll use this information? This information we'll use in working note number 3, as well as if there is any impairment. They make our life easier sometimes by saying that there was no impairment of goodwill. So then we do not need to do anything further. But if there is any impairment of goodwill, we need to gross up that goodwill if we have calculated goodwill on proportionate share of net assets. On 1st April 2005, the net assets of Beta as shown in the individual financial statements of Beta totaled 380 million. That means on the date of acquisition, the net assets were 380 million. The directors of Alpha carried out a fair value exercise to measure the fair value of the identifiable net assets. So it's a requirement of IFRS 3 business combinations that we need to fair value all assets and liabilities on the date of acquisition. Where we'll use this information? First, we'll read the question, we'll break it down where we'll use this information. While you are reading the question, break it down in terms of the notes where you need to use this information. First line, working note number 1. Second line, working note number 3. Third line, working note number 3 will need the cost of investment. Then the fair value adjustments again will need in working note number 3 when plant and equipment having a carrying amount of 120 had an estimated value of 140. So there's an increase of 20 million which will be adding as fair value adjustments as part of the cost of investment. Net assets of subsidiary. Brand name has a fair value of 30 million. For the first time it is appearing in the books. Working note number 3 will charge depreciation. Contingent liability relating to it. So according to IFRS 3 business combinations, we need to fair value the contingent considerations. So if there is anything such, we need to include it as part of our fair value of assets and liabilities. So fair value of this contingent liability is 15 million to be included as part of working note number 3. Fair value adjustments have not been reflected in the individual financial statements of Beta. That means we need to include them. The fair value adjustments are temporary differences which attract deferred taxes. That while we are calculating working note number 2, net assets of subsidiary, we also need to take care of the deferred tax as well. All depreciation and amortization of non-current assets is to be charged to cost of sales. Now, whatever depreciation and amortization we need to charge on this plant brand, we need to include it as part of the cost of sales while we are preparing income statement. On 1st April 2005, Alpha made a loan to Beta of 200 million. The loan carried an annual interest of 10%. So how much is the interest amount? 200 million into 10%, that is 20,000. Interest is payable annually in arrears and loan is repayable by Beta on 31st March 2009. That is 2 years after it. The interest payable on both 31st March 6 and 31st March 7 was paid by Beta on the due date and recognized by Alpha as investment income. So is it an investment income for Alpha or we'll exclude it? If you notice, there is an investment income mentioned. Investment income consists of 45,000. This includes also the interest income from Beta. Investment income note number 6. Total 45,000. There is a dividend received from Beta. Interest received from Beta is 25,000. 45,000 we have already dealt with. Dividend received from other portfolio. What about these dividends received from Beta and interest received from Beta? Will they form part of investment income as part of consolidated income statement or not? Or do we need to exclude them? What do you say? Dividends or incomes received from subsidiary, asset of one entity and liability of another gets cancelled on consolidation. So will we include the incomes also received from them, whether in terms of interest income or whether in terms of dividend income received from subsidiary? Will we include as part of the consolidated income statement? What is your take on it?
Yes, it will be deleted as inter.
Since we are going to add up line by line revenue of parent with revenue of subsidiary, cost of sales of parent with cost of sales of subsidiary, we are adding line by line the income statements. It will have no meaning if we add it up again. The dividend received, because one side it is income and for one side it is an expense, or they have deducted it as part of the retained earnings. They have recorded interest expense, one party has recorded interest income. It should be cancelled on consolidation. So we'll remove 9,000 and 20,000 from the total of investment income of 45,000. But we will definitely include the dividend received from portfolio of equity investments. It has been received as 11,500. So we need to know the fair value of these investments and we'll include that fair value of these investments. If there is any change as part of investment income. We'll do it as we progress, but hope this is clear. Research and development project. Alpha began a research project. The aim of the project was to investigate ways of streamlining its production process. The initial cost of setting up the project was 5 million. From 1st April 6 to 30th June 2006, ongoing projects were 500,000 per month. On 1st July 2006, the project was considered to be technically feasible and commercially viable. That means they can begin capitalization from 1st July 2006. We are preparing financial statements of 31st March 2007. So we need to cease expensing them from 1st July 2006 and we can capitalize the project from 1st July 2006. The project was completed on 31st December 2006. So how many months of capitalization we can do? 1st July to 31st December. How many months of capitalization? Hello. How many months of capitalization? July, August, September, October, November, December, 6 months, 6 into 6, that is 36,000. We can rounding to 1000, that is 600 into 6, that is 3600. We can capitalize. The project was completed on 31st December 2006 and new production process began to be used from 1st January 2007. So if we are capitalizing a development asset from 1st July to 31st December as 3600, will there be any amortization on it? And if there will be any amortization for the period, how much of amortization? How many months of amortization? The new process is likely to produce economic benefits for Alpha for 5 years from 1st January. So it is put to use from 1st January 2007. We are ending our financial statements on 31st March. It has been used for 3 months. We capitalized it for the first 6 months. It is capitalized at a cost of 3600. Then we had put it to use and we used it for 3 months. Alpha charged all the costs to complete the project to administration expenses. That means whatever they were incurring in the form of 500,000 or 600,000, they have charged the entire cost to administrative expenses. What is the balance of administrative expenses? Administrative expenses 29,000 for beta and 50,000 for alpha. When we total up, we'll be totaling up 50,000 plus 29,000, that is 79,000. Out of this 79,000, what we need to remove? How much amount we need to remove? Alpha has been including it as part of our administrative expenses. They were expensing of the entire amount, but 3600 of it needs to be capitalized, but they have expensed of the entire amount as part of 50,000. What shall we do? What shall we do? 3600 is not eligible for including as expenses in P&L, so we'll remove this 3600 from the total administrative expenses. But we are also required to charge amortization or depreciation on this. How much is it? This is intangible asset which is in the development stage, put to use. How much will be the amortization on this? Can you please help? Administrative expenses. Total of alpha plus beta administrative expenses will be 50,000 plus 29,000. Total is 79,000. Out of which less intangible asset capitalized, that is 600 into 6 months from 1st July to 31st December. We'll remove 3600 from it to be included, amount to be included in P&L. In income statement. will be equal to, for administrative expenses, it will be 79,000 minus 3,600. So we'll include 75,400 as the amount to be included as part of income statement. But we'll charge amortization on it. Amortization on this intangible asset. We capitalize it for 3,600. We use it for 3 months. The useful life of this asset is 5 years.
I'm not clear on this calculation, amortization and intangible assets. How come we?
So Sapna, they're beginning to use it. If you notice here, the new process is likely to produce economic benefits to Alpha for 5 years from 1st January 2007. Our year is ending on 31st of March 2007. So how many months?
3 months, Jan to March.
And useful life is 5 years, so we'll charge depreciation for a period of 5 years, but applicable for only 3 months. Where we'll charge this? 180. Where we should charge this? What it says. All depreciation and amortization of non-current assets is to be charged to cost of sales in the consolidated financial statements. Where will charge this 180? As part of cost of sales. So remember to include when we are calculating the cost of sales figure. Since I was discussing this, I thought to close this note here only. Clear? Then there is impairment. We'll do this impairment review. We'll come to this note when we have actually calculated goodwill. This will make more sense to us. Intra-group trading, when we are adding up the revenues and we need to adjust intra-group trading on revenue as well as cost of sales, and either increase the cost of sales or decrease it from gross profit. Will come to this point. Then Alpha's revenue, when we are, so let's read the Alpha's revenue line. On 1st October 2006, Alpha sold a machine to a customer for a total sales price of 27 million. The terms of the sale were that Alpha would provide the customer with a 3-year service warranty. The service warranty covered all repairs which might be necessary should the machine break down in the 3-year period. The normal selling price of the machine without the inclusion of any service warranty would have been 24 million. So if you remember IFRS 15 revenue from contracts with customers, there was a step 4, that is allocate transaction price, and we were required to allocate this transaction price on the basis of relative standalone fair values. The relative standalone fair value of the machine is 24 million. Alpha would normally charge a customer a total of 6 million to provide a 3-year service. That means in total, the relative fair value of 3-year service warranty is 6 million. The relative fair value of machine is 24 million, but Alpha sold it only for 27 million. So will we allocate this cost in the proportion of 24 and 6? What do you say? Alpha received 27 million, but they need to break it down into how much they received for the machine and how much they received for the 3-year service warranty, because they are selling this 3-year service warranty separately, and it also has a fair value. They received lesser amount in comparison to the fair values. So how much they will allocate to each, how much they'll be allocating to machine and how much they'll be allocating to revenue received for machine and for 3-year service. The relative standalone prices are 24,000 and 6,000. total fair value in the market is equal to 24 plus 6, but amount received for both is 27,000. So if we allocate the transaction price between machine and 3-year surveys, how much will you allocate to machine? In the same proportion, 24 divided by 30 into 27,000 should be the revenue recognition for machine, and revenue recognition for service for a 3-year period will be 6 divided by 30,000 into 27,000. When did this got purchased? This happened on 1st of October. So how much of service revenue we can recognize? How much of service revenue? The total revenue we can recognize over a 3-year period is 5,400. How much revenue we can recognize this year? If you read the dates correctly, on 1st October, Alpha recognized revenue 27 million and charged the cost of manufacture to cost of sales. This is not correct because they cannot recognize the entire 27 million received. They have to bifurcate it in terms of machine and service. Any costs incurred by Alpha under the service warranty arrangements during the period from 1st October 6 to 31st March 17 were charged as cost of sales. The service warranty arrangement does not represent an onerous contract for Alpha. That means they abided by it and it's going to happen. So how much is the revenue to be included from 1st October to 31st March? This is the revenue for machine, 21,600. Revenue this year. And for 3-year service, $900. Perfect. So 5,400 is for 3 years, that is 36 months. We need it only for 6 months period, which equals to 900 is the revenue we recognize this year. How much we have actually recognized? We have recognized 27,000. So total revenue we can recognize this year is 21,600 plus 900. How much we actually recognized? 27,000. What about the difference? This will be reversal of revenue. Adjustment required in revenue. Is this clear? Hope this is clear with everyone. Research and development, we've already dealt with. Alpha's investment income, as I said, these two will be removed. Third, we have dealt with. Fourth, we'll deal with when we are dealing with dividend received from portfolio of equity investments. Alpha's investment in Gamma, we have dealt with. Okay, let's deal with Alpha's portfolio of equity investments as well, and then we can move on to the other part. Alpha's portfolio of investments. Now, sequence is your choice. You can either calculate first your working note number 1 to 5 and touch these points later on, because these points are going to help you in your working note number 1 to 5. The sequence is a choice. In what sequence you wish to do it. Let's read it. Alpha's portfolio of equity investments is held for short-term trading. That means it should be measured at fair value through P&L. Short-term trading is for fair value through P&L. During the year ending 31st March 2007, Alpha made additional purchases at a total cost of 8.5 million, which were added to the portfolio. During the year ended 31st March 2007, Alpha received 7 million from the proceeds of sale of investments from the portfolio. So they have sold worth 7 million, they purchased worth 8.5 million. These proceeds were deducted from the carrying amount of the portfolio on 31st March. So they're telling us what is to be done. These are to be deducted from the carrying amount of portfolio because we are preparing income statement. They have not given us the balance sheet figures. On 31st March 2006, the fair value of the portfolio was 35 million. So this is the starting point. 31st March 2006, starting point, opening balance. Opening balance at fair value as on 31st March 2006. There was 75 million, that is 75,000. This is the opening. The fair value of portfolio was 75 million. This amount was recognized in the financial statements of Alpha at that date. On 31st March 2007, the fair value of portfolio was 84 million. So we know the closing value. Closing balance at fair value as on 31st March 2007, that is 84,000 given to us. They made additional purchases during the year. Purchases during the year worth 8,500. Disposals during the year purchased 8.5 million. During the year ended, Alpha received 7 million from the proceeds. These proceeds were deducted from the carrying amount. So we need to deduct this 7,000 from the minus 7,000. So total turns out to be 76,500, but in reality the total is 84,000. What about the difference? What about the difference? On revaluation, this should have been the total. 76,500 should have been the total. But on remeasurement, we got to know that it is actually 84,000. So the difference is again on fair value exercise. Gain on fair value exercise is 7,500. Where will include this? Where we will include this gain on fair value exercise? What is the balance of investment income? Investment income balance is 45,000. It is told to us that out of this 45,000, we need to remove 29,000. Dividend received from investment in Gamma will be shown separately as share of profit from investment in Gamma. Hope you remember IS 28 investment in associates. Any share of profit is included as part of the income statement. How much is the share of profit? Investment in Gamma. Share of profit for investment in Gamma has to be included as part of income statement as a separate line item. So this 4500 has no significance now. So this has already been removed from investment in income. 29,000 will be removed. This 11,500 will remain, and this will increase by 7,500. How much is the total to be included as part of investment income? Investment income alpha plus beta as given in the question, it is worth 45,000. It is also explained in the note, it is worth 45,000. From it will less the dividend received from beta. Why we are deducting it from here? Because we are going to add line by line consolidation. The reason we do line by line consolidation, so it automatically forms part of it. We'll be removing this 20,000. Dividend is 9,000. We'll also be removing interest received from beta because that is an intra-group transaction, and expense of one entity and income of one entity, they get cancelled on consolidation. So we remove this 20,000 as well. Minus 20,000. Dividend received from investment in Gamma is also replaced now with the share of profit from associate. So we'll remove the dividend received from Gamma as well. We'll remove 4,500. We'll add the increase in fair value of investment, increase in fair value of portfolio. And we can say that we did it in note number 9. Which is equivalent to 7,500. So the balance which will show in the income statement will be total of 19,000 will be presenting as income statement, the adjusted balance in the consolidated income statement. You can directly pick it from here from working note number 10. So you dealt with all the notes except now the major ones, that is note number 1, 2, and 3. Let's do it. Working note number 2. Net assets of subsidiary on date of acquisition and date of balance sheet. How much is the net asset subsidiary on date of acquisition? Date of acquisition was on 1st April 2005. Beta's net assets totaled at 380 million on that date. Opening balance is 380 million, that is 380,000. How much is the net assets on date of balance sheet? This was acquired at the beginning of 1st April 2015. We are preparing financial statements of 31st March 2007. It was acquired on 2005. So the balance, opening balance of this will be, this is the balance of 1st April 2007. You'll need the balance of 31st March 2007. This is 1st April 2005. Fair value adjustments. The net assets of Beta is shown in financial statement total 380 million. It begins life from plant and equipment having a carrying value of 120, had an estimated value of 140. Plant and equipment began life with 20,000. What will be the value on date of balance sheet? If it has a useful life of 4 years, there's an increase of 20,000, useful life of 4 years. What will be the balance on 31st March 2007?
5,000.
5.
5,000.
5,000 will be depreciation or 5,000 will be
5,000 is actually the depreciation charged for 3 years. So 20 minus.
why 3 years? Why not 4 years when the remaining useful life is 4 years?
We are at the 2007. So
End
2000.
of 2007, beginning of 2005, 1 year, 2 years depreciation is going to be charged.
Oh yeah, sorry. 2 years depreciation.
2 years depreciation means
10,000.
20,000 divided by 4 into 2, 10,000. So this is left with 10,000 of amount. Brand 30,000. Date of balance sheet value. It has a useful life of 10 years. 2 years depreciation. 30,000 divided by 10 into 2. 6,000 depreciation. So 30,000 minus 6,000. 24,000 is the value of the brand on 31st March 2007. Contingent liability. Relating to pending legal case was disclosed in the notes to financial statements of Beta at 1st April. The contingent liability had a fair value of 15 million. Contingent liability had a fair value of 15,000. What will be the balance of contingent liability on the date of balance sheet? It says that contingency was settled during the year ended 31st March 2006. If it was settled, that means it will not come on the balance sheet of 31st March 2007. Agree? 0.
So even if contingent liability is shown as a note in the financial statement, we take it as a part of calculation for net assets.
So there is a confusion here that IAS 37 says that contingent liability is part of the notes. IFRS 3 business combination says that if you are acquiring another entity, you need to fair value their assets and liabilities. So when you fair value their assets and liabilities, that's this contingent liability got a fair value on the date of acquisition. So this forms part of your acquisition calculations. So this is a principle of IFRS 3, not a principle of IAS 37. This is from the seller's point of view and buyer's point of view, that buyer or seller, they are considering this contingent liability as well in their calculation of sale purchase. That this may also come up. So that means the buyer is paying more, because if he has to bear this liability in future because of this acquisition, he is in reality paying more of 15 million. So he takes it into consideration as part of the cost of acquiring, that I'm paying for this as well. Apart from this, there is one more contingent consideration which is used when
Fair value of consideration.
when the buyer says that he gives a rosy picture to the seller, to the buyer, sorry. The seller gives a very rosy picture that our profits will be this much, the firm is going to grow 10x in the next 5 years, or it is going to grow 3x. So the buyers are also smart. They say that if your revenues cross the amount you are telling us, we'll give you additional $300,000. But that $300,000 is contingent upon occurrence or non-occurrence of a future event, which may happen, which may not happen. That if you by chance reach the level you're talking about, we'll pay you additional. So in this calculation, IFRS 3 business combination says that in your cost of investment, you also include fair value of contingent consideration. So we would have included in the cost of investment contingent consideration. That's the contingent consideration discussed in IFRS 3.
Yeah.
Now this is contingent consideration. This is not a contingent consideration. This is actually a contingent liability which has got a value in terms of net assets. Because when a buyer is buying, they are buying the net assets of the entity. When they get to know that the net assets are not worth 100 million, because they'll have to pay 15 million, the net assets are worth only 85 million. So they deduct this 15 million. The net assets are not worth this. So reduce it.
Okay.
Got it? So I'm looking for the opening balance of 31st March. That is the balance on 31st March 2006, which becomes the opening balance for calculating the balance for 31st March 7. We get it in note number 2. The goodwill on acquisition of beta was reviewed for impairment on 31st March 6 and no impairment was considered necessary. On 31st March 6, the individual financial statements of beta showed a net assets of 390 million. That is the opening balance. 390,000 is the opening balance for net assets of subsidiary on 31st March 2006. So we are trying to calculate the balance on 31st March 7 and what happened between 1st April 5 to 31st March 7. And during this period, there is a dividend paid by the subsidiary. How much is the dividend paid? They paid a dividend of 12 million. So can I reduce 12,000 from here? So that will be reduced only from this balance. And since it was paid on 1st March 2007, so from this balance, 1st March 2007, at the beginning of this month, can I reduce it from this column? All the fair value adjustments have not been reflected, so we have done so. All depreciation and amortization will take care of it in cost of sales. On 1st April 2000, Alpha made a loan of 200 million. We have already dealt this, removed it from the investment income in note number 11. Hope you remember. Remove 20 interest received from beta 20 from note number 10. This part we have already dealt with. Now we need to deal with note number 2, out of which we have dealt with 390 million and 12 million. But it also says that the fair value adjustments are temporary differences which attract deferred tax at a rate of 20%. So what will be the deferred tax on it deferred tax at the rate of 20%. And deferred tax will be applicable on which amounts? These three and these two, because these are the fair value adjustments. Deferred tax of 7,000, and here it will be deferred tax of minus 20% of 34,6,800.
It's a deferred tax liability.
Yes, it is a deferred tax liability. Because we are going to earn more in future. We believe that we are going to earn more in future. We believe that we are going to pay more taxes in future, but tax authorities are not agreeing to it. So earnings are more, expected earnings are more in future.
Or the carrying amount of the asset is higher. It's the same, right? Than the tax base.
Yes. When carrying amount of an asset is higher than the tax base, it gives rise to
Liability.
yes, right. How much is the profit for the year to be included for the period first April 2006 to 31st March 2007? How much is the profit for the year? This is little trickier because it has taken into account 2 years. We need to know how much is the total increase. Now this calculation normally we do for balance sheet, but I'm using the same pattern so that you can remember it. So this is the opening balance of 31st March 2006, net assets on 31st March 2006, but there is an increase in these net assets during the year, and these adjustments had not taken place. So how much is the increase in the net assets during the year? Where will get this information from? From the income statement? Profit for the year for the period 1st April to 31st March 2007 is 24,000. So that means the net assets increased by 24,000 during the year. The opening balance of net assets as given to us is 390,000. This is on 31st March 2006. This net assets 390 million has increased by 24,000 during the year. Agree? Profit for the year period 1st April 2006 to 31st March 2007 is given to us as 24,000. So how much is the balance to be included as on 31st March? This is 429. 200 is the consolidated balance to be included as part of the. So total increase in earnings. Though this is not relevant from exam point of view, but this is the total increase in earnings from date of acquisition till the date of balance sheet. We'll need this information for NCI valuation. How much belongs to NCI?
$5,300.
So this is the position of NCI on date of balance sheet. NCI on the date of balance sheet, total percentage is 429 to 100. But this includes the profit of 2 years. 21,200 includes the profit of 2 years. So if we just need to know the profit for this year only, we need to remove the profit of the if you notice here, this 24,000 is including the profit for the current year, previous year. NCI's profit is in this with some adjustments. We've already done adjustments for 10,000, 24,000 contingent liabilities. Therefore, tax is how much is the difference? There's a difference of 200, 7,000 and 6,800. That means this total adjustment in the current period is of 200. So we'll see if is there any unrealized profit sold by subsidiary to beta. Alpha provides beta. So this is an adjustment to be done in working note number 5, but no adjustment to be done in working note number 2 here. If beta would have sold to alpha, then we would have made some adjustment here as well. So when we'll discuss NCI's valuation, we'll discuss about it. So this is the balance on date of acquisition. This is the balance on date of balance sheet. Working note number 3. Calculation of goodwill. What we need to take care of in this? Cost of investment. Value of NCI. Fair value of net assets of subsidiary on the date of acquisition. Which we'll get from working note number 2. Value of NCI, a proportion of it, it says that NCI is measured on proportionate basis. So a proportion of this belongs to NCI. That is 25% of 408,000 belongs to NCI. 102,000 is the value of NCI. Cost of investment is given to us as 327 million. 327,000 is the cost of investment. What is the value of goodwill? This belongs to parent only. 327 plus 102 minus 408,000. The value of goodwill as recognized in balance sheet is 21,000. Now this is subject to impairment. How much impairment? Impairment review. Beta is a single cash generating unit for impairment purpose. On 31st March 7, the estimated recoverable amount of beta as a single cash generating unit was 448 million. This is the recoverable amount. And impairment of goodwill should be charged to cost of sales. We'll calculate what is the impairment loss, which will be charging to cost of sales. So what is the value of beta? Net assets of beta on net assets of beta on 31st March 2007. We just calculated, they are 429,200. We add goodwill to it. Now this is goodwill belonging to parent only, parent's goodwill. We need to know the total goodwill. So we gross up the goodwill. This 21,000 is representing what percentage? 75. How much would be 100? $21,000 represents 75%. How much would be 100? 28,000. So we cross up the goodwill. 21,000 divided by 75 into 100. This will represent the total net assets of subsidiary. Goodwill added to the cash rendering unit is 28,000. Total value of the entity, that is the carrying amount of beta, is equal to 457,200. This is compared with recoverable amount of beta for the purpose of testing of impairment. Now this process is known as testing of impairment, which is given to us as 448,000. Carrying amount is higher than the recoverable amount of beta, so there is an impairment loss of how much of this loss belongs to NCI and how much of this loss belongs to the parent. This loss will entirely belong to parent because the goodwill is belonging to parent only. So we'll charge to the cost of sales only to the total loss is 9,200, but how much belongs to the parent? Impairment loss to be recognized as cost of sales. How much? 9,200 is the total loss, but parent has a share of only 75% of it. So 75% of 9,200 is the loss to be charged as cost of sales. Is this clear? When we calculate the value of NCI on proportionate basis, and if there is an impairment of goodwill, we need to gross up the goodwill. We need to calculate the notional goodwill. Now, this is notional goodwill. This is also known as notional goodwill. Just for the purpose of impairment, only for the purpose of impairment we calculate it. Is this clear? Working note number 4. Value of non-controlling interest. Value of NCI on date of acquisition, which will give us the value as we calculated, 102,000. Share of profit of NCI, if I go with this amount, then it is parent and NCI. $5,300. We had taken into account the deferred taxes on this fair value movement, but we did not take into account the deferred taxes on the depreciation and amortization charged. How much is the depreciation amortization charge for the current year in this?
Amit, why we are not considering goodwill in calculating net assets of subsidiary?
Goodwill belongs to whom?
The entire goodwill
No,
of
goodwill belongs to whom?
beta. Goodwill of beta of 28,000.
Goodwill is purchased by the parent. It forms
Okay.
part of consolidated financial statement, so it belongs to the parent.
Okay.
It belongs to parent, and so they have purchased goodwill, and remaining goodwill is of the NCI. In this case, we do not assign any goodwill to NCI because we have valued NCI and proportional share of net assets. Fine.
Yeah.
So we are left with one note, that is on intragroup trading, and the fair value adjustments have not been reflected in the financial statements of beta. The fair value adjustments are temporary differences which would attract deferred tax at a rate of 20%. We have taken this into consideration, where else there is deferred tax. Any adjustment for unrealized profit or temporary differences which will attract deferred tax at a rate of 20%. So this calculation is for the balance sheet positions. That balance sheet position after 2 years from the date of acquisition from 1st April 5 to 31st March 7. This is perfect. And the value of NCI, like share of profit from the date of acquisition to the date of NCI, is 5300. So working note number 4 is share of profit from NCI. Working note number 2 will give us 5300. This is the amount, though we do not need this information, but this is the amount to be presented as part of the balance sheet. What comes as income statement, since we are preparing the income statement for the period, and this 5300 includes the earnings of 2 years, because we need to present the balance in the balance sheet. So I was a little bit confused between the 2 years earnings to be bifurcated. Now this 5300 is if I divide it in terms of what belong to year 1 and what belong to year 2, because we need information for the NCI's earnings for the period 1st April 2005 to 31st March 2006. So if you look at the net assets position from 1st April to on the date of acquisition, it was 380, and to 31st March it reached 390. So total earnings during this period, is equal to 390,000 minus 380,000, that is 10,000. NCI share in it is 25%. Now individually, if I say that this required deferred tax adjustment as well of the increase in value. Now there is a depreciation charge during the year of 5,000 in year 1, 5,000 in year 2, total depreciation of 10,000 over a period of 2 years. 5,000, 3,000 in year 1 for brand amortization, 3,000 in year 2, total depreciation for a 2-year period is 6,000. So it concluded from 30 to 24,000. Now this 5,000 and 8,000 required a deferred tax adjustment of 1,600 in the total earnings. Deferred tax expense of 1,600, which reduced the profits by 1,600, because we believe that there is going to be a liability in future. So deferred tax adjustment in it is 1,600. NCI's share 25% of it, 8,400. 25% of it equals to, okay, let's not confuse ourselves here. This is fine. As far as balance sheet is concerned, this is the movement from the date of acquisition to the date of balance sheet. We have done it perfectly well. I was only concerned about the deferred tax adjustment, which is supposed to be done in the period beginning 1st April 5 to 31st March 6. There is a deferred tax adjustment to be done, and there is a deferred tax adjustment to be done in 1st April 2006 to 31st March 2007. Now, in our calculation here, in working note number 2, net asset subsidy, this is done together because since we are taking directly applying the percentage on the balance sheet amounts, this has been dealt with perfectly. But when we are dealing with the income statement, so what the confusion here is that I had picked up both the P&L and balance sheet together. So this, as far as balance sheet is concerned, we are perfectly on track. This is the amount to be shown as part of the balance sheet in working note number 4, value of NCI. Share of profit of NCI will be equivalent to 5,300. There will be no impairment because no impairment since the goodwill belong to parent only. So the balance of NCI to be shown as part of balance sheet will be, though this information is not required, I am purposely doing it so that this becomes useful when you're preparing a balance sheet. This information of working note number 3 is not required as part of this question. We need only this information, how much loss to be recognized as part of cost of sales. For that purpose, we had to do these calculations, calculation of goodwill and net asset subsidy on the date of acquisition, date of balance sheet, so that we can know what is the movement. This information is not required as of now because this is not relevant. If we would have prepared balance sheet, this would have been relevant directly. We would have used these balances, but we need to prepare income statement. So in that appropriation of profit of how much belongs to NCI, my mind was drifting away for trying to calculate this adjustment of 1600 for the current period. But in this balance, it is already adjusted for 2-year period. So is the reason I was trying to think through it, that how much will be the adjustment for NCI of deferred tax adjustment for the current year. We'll look at it when we are preparing the income statement. When we actually preparing the income statement, I think that confusion will be clear.